Over the past few weeks, I honestly haven't seen many setups using my main trading approach, and that's not necessarily a bad thing. The market has been extremely strong lately. Most stocks in the top 100 have just been grinding higher and higher without really with much of a pullback into the kinds of entries that I'm looking for, which is coming on the monthly to a demand zone. But because I genuinely enjoy trading and studying price action, I started asking myself some questions. Could there be a similar approach? Something that's analogous to my setup that works better in these types of market conditions. So I did spend a few hours on one of the days last week just backtesting an idea for two. Nothing crazy, nothing overly technical. One of the approaches was super similar to what I'm already doing. And within one single trading day, using $10,000 position, I was able to return over $600. So that's almost 6% return on three different stocks. Now, obviously, this is not life changing money, and honestly, this could absolutely just be luck. But that's why I kept the risk small and controlled, because I have nowhere near enough data yet to fully trust this approach. But what caught my attention specifically was how simple the setups were. And in this video, what I'd like to do is I want to walk you through these three different trades I took this week, how I managed the risk, what I liked about them, what I didn't like, and maybe it'll give you an idea of what you can build for yourself. Again, this is purely educational. It's not a financial advice. It's just me documenting the process.
All right, so let's just jump into TradingView because it'll honestly be a lot easier to explain visually. There were three different trades that I took this week. I took one with Apple, and the other two were Qualcomm and Merck. Now, the first one, what's interesting is that Apple was actually a completely different experiment from the strategy I normally use. The Qualcomm and Merck trades were a lot closer to my current approach. There was pullback into a demand zone, compression, breakout structure, things like that. But Apple was me testing a hypothesis. And honestly, this is what I enjoy most about trading. Not the gambling aspects, not the dopamine, but trying to understand behavior and structure. So here was the idea. A lot of the top companies in the market right now have been extremely strong. They've been trading higher without really pulling back deeply enough for my normal swing trading entries. We can take a look at on the daily time frame or maybe on the monthly time frame right here. Nvidia, Microsoft. Microsoft is a little bit below, but I'm already invested there. Apple, Google, Amazon is doing pretty well. Meta is in a demand zone, so I'm already invested there. Broadcom, Tesla, ASML, JP Morgan, and etc. So, anyways, uh, what I ended up asking myself was if the monthly time frame is bullish. So let's take a look at the example with Apple. Monthly time frame is bullish. All of these different EMAs, I added another one, which is the 20 EMA, are all aligned, and you can see that this is clearly in an uptrend, right? I'm just gonna hide the drawings just for a little bit. If the if the monthly time frame is bullish and the daily time frame is also bullish, could I simply use that long-term strength as a directional bias? And then what I want to do is exploit it short term. Something more like an intraday, maybe a couple of days at most trade. So the focus for me became the market open. So on the monthly we saw it was an uptrend. This is also on the daily time frame. It's been on an uptrend at least clearly since April here, right? We can see all the different EMAs being on top of each other, right? And then you can also take a look at here, there was a little bit more of a choppiness because Apple had retraced to a demand zone on the monthly time frame. So all of these lines here, what's shown in yellow represents the end of day, and what's shown in blue with a dash line are is basically the market open. So 9:30 a.m. Eastern Standard Time. What I did was pretty simple because I know that the market becomes very volatile, very aggressive. There is a lot of money that's getting poured in at market open. So that time between 9:30 and 10 a.m. This was actually the trade that I took, and that was going into obviously Friday here. So while I took it Wednesday, I did leave it hanging until Friday, even though I just mentioned that, this is more an intraday trade, possibly 2 days trade at most. But there is always the potential of leaving it for a lot longer than that, as long as you're managing it correctly. So let's focus on it. What do I mean here? At the end of the previous day, which is again all of these yellow vertical lines, I identified the most recent short-term peak. So, for example, this is the most recent short-term peak, and I draw a horizontal line. Let's go to the day before. This was, you can see 345.4, short-term peak. Another yellow line here represents the day before. Now, here you could argue that this was a short-term peak, but this was just a single candle. So I just drew the line over here. It wouldn't have made any difference anyways, but for me, this was considered a peak. Let's take a look at one more example. This was end of day, only a few candles before that there was a short-term peak. So what I then look at is the next morning at the opening price between 9:30 and 10. And please keep in mind, I am a full-time employee, so I do have a lot of meetings throughout the week during this time. And this is not something that I plan on following unless I'm really free during the time alert level comes in, and then I can act within like few minutes just if I'm available going to the bathroom or something like that. It's rarely the case. It just happened that on Wednesday I was free during that time. I did not have a meeting and I was able to enter the market because an alert came to my phone as I was setting it up. So what do I look for? What I look for at the opening is between 9:30 and 10. So that's pretty much two candles because it's a 15-minute candle. 2 to 3 candles, let's just say. I'm looking for those candles to break that structure or close above this horizontal, let's call it green line that I have extended. And you can see that here, that did not happen. This is already 10:15 at the end of this candle, right? So there was no real play here last 2 Fridays ago. There was no play here. There was actually a play over here. Why? Because the previous day, the last peak was this. I had drawn a horizontal green line, and for the next morning, I was waiting at the opening candle for something like this to play out. This was a very, very strong candle. Now, would I have entered this? And the answer would have been no. And the reason why I wouldn't have entered is because you see these EMAs here, they're they're below the 100 and 200 EMAs. What I want from these is ideally to be higher than the 100 and 200 EMAs. And the price action definitely needs to be higher than that. So it needs to go 10, 20, and then 100, 200, 200, 100. It's not going to be a big deal. So this would not have been a play for me. Regardless, even if I kept it as a play, this would have been probably a winner. I mean, as you can see here, my stop loss would have been below the bullish candle and would have been a winner. Now, let's take a look at the Wednesday. What happened there? This is where I had entered the trade. So the previous day, Tuesday, market closes. I draw a horizontal line. and I wait for the next morning open. There was a very strong bullish candle. Also, these are not ideal, but I decided I'm going to take the opportunity and actually do it. Alert comes to my phone. I see that the candle had closed above it. I go in, I put in around $4,000 or $5,000, and the risk is pretty low. Um, you can see this is almost like 1.2% loss for a 2 to 1, so almost like a 2.38%, 2.4% if it reaches a 2 to 1 risk to reward. So for $5,000, gaining 2%, that's around $100. 2.4 would be $120 or so. And I would have lost $50. So I was okay with that. I entered here, and as you can see, this is basically at the end of the day, right? And I could have exited. This would have been pretty much a break even point. But I decided, you know what? I'm going to wait. I'm okay with losing $50 if that's what's going to happen. And then the next day, the price was already moving in my direction. So I was already up 50 some dollars or 1%. So 1 to 1 risk to reward. And I decided, okay, I'm just going to move my stop loss to break even. It has already been a day or so I've been in this trade. I'm just going to hold it until the end of the week, which was a Friday. And then you can see where it ended up being on Friday. This is where I exited and I gained a little bit of money. And that was really it. This was a very simple setup with Apple using this strategy. And it's actually a pretty good one because I did do a little bit of backtest on some of these other stocks as well, but this is some examples on Apple. You can see very similar setup. May 13th, previous day, at the close of day, this was the peak. I drew a horizontal line, 9:30, very strong bullish candle, closes above it. You can place a entry point right over here, place the stop loss below the bullish candle, and then also take a look at all of the different EMAs are perfectly aligned with each other. And this is where one can make a decision how to manage this trade, right? It doesn't have the best risk to reward. So if I had exited at the very end of the day, that's a 0.7% gain to the account. Sorry, that's a 0.8% gain to the account. And the risk to reward is 0.7. So it's not a very favorable one. I could have, one can take a partial at 1 to 1 and then move the stop loss to break even. That's also a possibility. So for me, or you could let it for a lot longer and aim for the 2 to 1. And you can see here after 1 to 3 days or so, that's 1.86. Came pretty close. Definitely not 2 to 1. But if I had left it for almost a week, it would have hit that target. So there are different management styles, and it's really up to you how you want to do it. That's why I think it's important to, perhaps for this strategy, is to limit it to make it a lot shorter term, meaning enter it, wait until the end of the day, and manage it. Either get out or at least set your stop loss to a break-even point and let it run. Let it run until you reach a 2 to 1, or let it run for as long as you want to. So again, this is not some deeply tested strategy. This is literally me just observing the market behavior and testing a hypothesis. And surprisingly, Apple worked out very well. And looking over this strategy over at least the last few months, it actually gave a lot more winners. And maybe there was only one loss when I was doing the back test. So I think I'm going to take a look at this in a little more depth over the next few weeks or so. The second one on the list was Qualcomm. and Merck. But let's take a look at Qualcomm first. I wanted to go a shorter time frame for Qualcomm and Merck. And instead of doing the monthly and daily, I wanted to use a daily and 4 hour, weekly and daily time frame. So in the case of Qualcomm, um, I can see here, at least on the monthly time frame, this is in an uptrend. So I know that all of the EMAs being aligned with each other indicates that this is a clear uptrend. But I am focusing on the daily time frame, and that needs to be also in an uptrend. And I can see also that the EMAs are aligned in this area, which indicates that this is in an uptrend. So I still am waiting for a discount level, just like the normal strategy that I talk about on this channel. And this was a decent demand zone, strong bullish candles. Yes, there were some weeks, but this is also a daily time chart as opposed to monthly time chart. And I thought that this was a decent demand zone. Then what I did was I dropped down a time frame. I came down to the 4 hour time frame. And once the price was in this demand zone, which is where it was already, I observed a compression, a consolidation. Now, this is not a consolidation I would typically draw up on my original strategy, um, because I would take account of the wicks. Here, I'm not really taking account too much of the wicks. I'm focusing more on the bodies of the candle to highlight that consolidation. And I'm mainly looking for the EMAs to also be aligned with each other to indicate a bullish move. So in this case, not only did we have a very strong bullish candle, which was much greater than all of these other candles here in this consolidation, it broke out significantly. So it wasn't just um, a smaller bullish candle or a closure just slightly above the consolidation. You can see that this is pretty clear here, how it had closed. And you can also see that on the 4 hour time frame, this is where the 10 EMA was coming from below. It was pointing upwards. The 20 EMA was already pointing upwards, and I was anticipating that this will cross. So when the next 4 hour candle started, knowing that this was already a bullish candle, I entered right over here. And so that was a Thursday around noon. And pretty much the next day around noon as well, look at what happened. It went up 15%. So this was pretty much a 3-to-1 risk to reward. So this worked out very good as well. And the final example was Merck. The example with Merck, again, on the monthly time frame, are we in an uptrend? Yes. You can see that all of the EMAs are aligned. But I was looking at something on a lower time frame just because I wanted to see if the setup is going to work on something shorter time frame. And in this case, there was a nice weekly demand zone. Few strong bullish candles. They have taken out the previous high over here. Waiting for a pullback, knowing that the price had come to a demand zone. It had come to a discount price. Could go to the daily zone. And I'm looking for a nice consolidation, something where the price action is very compressed, something that it's narrow. It's narrow like this. You can clearly see the price was doing this, higher, lower lows and lower highs. And then when it came here, the price compressed. And then I was waiting to see if I'm gonna get a strong candle, stronger than any of these candles, previous candles over here, where the EMAs are aligned with each other, which just ended up happening at the closure of this specific candle. This was Thursday, it was end of day. So this is the daily time chart. I swear to God, I exited, I left work around 4:45. I saw this candle. I entered the trade. It was after market hours. I deposited around $3,000 for this one. And I deposited, I think, around $3,000 for Qualcomm as well. And I was very surprised to see that only after 30 minutes or an hour, the price had already jumped. It gapped above, and it gapped above because most of the price action developed after hours. So this was perhaps one of the luckier ones because it turned out to be great at basically within an hour of me entering the trade. Had I waited for the next day at like 9:30 or so, the price action would have already been here. That would have been too late. That would have meant that the candle would have extended drastically, and that's not something that I would have been interested in. So you can see this is the 5 p.m. up to 6 p.m. candle. So sometime between 5 and 6 is where this price action really jumped. And this is where it was at the opening, somewhere over here, the following day. So both of these trades, Qualcomm and Merck, moved almost immediately in my favor. See, Qualcomm became very strong winner the following day. Merck, I just covered. It went very well, very quickly. So let's wrap up this entire video. What is my takeaway from all of this? Well, honestly, probably not what most trading channels would tell you. I'm not walking away from this thinking, oh, I found the secret. If anything, this week reminded me how important adaptability is. Markets change, and sometimes your primary strategy gives you tons of opportunities, and other times it gives you almost none. And instead of forcing trades out of boredom, I think there is a value in studying analogous behavior, different structures, but same underlying principles. You see, trend, again, supply and demand, compression, momentum, and risk management. And that's really what I'm trying to understand better. I'm not trying to predict the market, but to have the probabilities in my favor. Now, whether this recent success was a skill, luck, or a combination of both, honestly, I don't fully know yet. And I think being honest about that matters because one of the biggest traps in trading is becoming overconfident after only few winners. So for now, I'll continue documenting some of these experiments and to collect data and refine the process and seeing whether there is actually something repeatable underneath all of this. And if nothing else, maybe this video gives you a few ideas to explore yourself. Thank you again for your attention, and until next time. Bye bye.